Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update. The week is November the 11th, 2019. So starting with the market state, if we're looking at the S&P 500, it is in market state 1. Market state 1 is one of the 5 bullish market states. One characteristic of market state 1 is the majority of market highs or new market highs are placed during this market state. Flip side of that is, a lot of pullbacks begin in market state 1 because the market sees a significant rally that it, can't sustain. So last little over 2 weeks here, we've had a little bit of a rally, and so it'll be interesting to see if the market can kind of keep up with that pace or if we do see some sort of pullback from here. Canterbury Volatility Index currently measures volatility index reading of 60. That is continuing to fall. That's, low and decreasing, which is what we want to see. However, short-term volatility or a 10-day volatility index is below extreme low, so it's at extreme low levels. So what that's saying is, volatility is kind of becoming stagnant, it's getting squeezed down like a spring, and you're more likely to see, a market outlier with a spike in volatility. Last week's update, we did mention that the S&P 500, kind of broke out above, overhead resistance. And at this point, it kind of feels like we're beating a dead horse, but the Russell 2000 does continue to underperform. So while the S&P 500 broke out above overhead resistance, the Russell 2000 is currently sitting right at that resistance level. So it'll be interesting to see if, the Russell's able to gain some momentum or gain some strength and break out above that, or if supply is going to take over and we see kind of a fall in the Russell. Moving on, I just want to talk about bonds. Well, all assets, securities, indexes, doesn't matter what it is, it's going to have both bull and bear markets, and bonds are no exception to that. And so while bonds are typically thought to be, conservative, if we look at this chart of 20-year treasuries that goes from May of 2016 to November of 2018, we can see that, 20-year treasuries had a lot of volatility and a high drawdown, over this time period. While the equities were in bull markets, had low and stable volatility, bonds actually kind of saw a 20% peak to trough decline. If we compare that to a chart of bonds from November 2018, through the present, we can kind of see that from, November 2018 up through August, bonds had a significant run up on, low volatility. And at the end there, in late August and September, you saw kind of a parabolic advance, and bonds began to fluctuate between a horizontal support line and kind of a declining resistance line. And we can actually see that recently, the 20-year Treasury bonds actually broke below that support line. So that's kind of something we can monitor moving forward to see if it is able to rally back through it or if it continues to fall and that support line actually becomes resistance. Looking at the Canterbury Portfolio Thermostat, it does have an efficiency score of 90, volatility is 28, and the benefit of diversification is 55%, so really not much change from there. So, markets are going to go through many different environments, both some will be bull, some will be bear, others will be transitional, and we have, making money really means nothing if we can't keep it. So markets see significant runs, they also see significant drops. So if we're sitting at peaks, there's no reason to believe that we're going to be able to sustain that or keep that money. And that's why we want an adaptive portfolio strategy, like the portfolio thermostat. And so that we can, potentially limit our drawdowns to normal bull market corrections and then better experience the benefits of long-term compounding, because that's really the goal of all investors. We all want to experience long-term compounded growth. But that brings us to the end of this week's update. Thank you, and I hope you have a great week.